Wow. Yeah, Todd, this is amazing. There's so many people that are overcomplicating this conversation and they use the cash value as well.
We're going to put life insurance, whole life insurance in place as part of our investment strategy. And we're going to compare that to if we didn't do that and we just bought into the buy term and invest the difference type of strategy. What if safe money is only 3%? What happens is our income goes down to $51,000. It directly impacts everything we're doing. We could leverage our guaranteed chance of dying at some point and the guarantee that whole life insurance will pay a death benefit at the point that happens. And let's leverage those two things against each other.
And because of a permanent death benefit, you're unlocking a lot of money, 1.5 million in some scenarios, but like that is insane. We're comparing the exact same distribution strategy. I've always mentioned like death benefit is important, but I think this is the first time that I've actually seen death benefit not commingling with cash value and all that other stuff. And I think this video should be a must watch for people that are nearing retirement, in retirement, that have a permanent life insurance policy. Very few people are having conversations about life insurance, and it's demonized as a bad investment, and it's a shame. It's a shame that people aren't understanding this, because we would be in a way better place. Hey everybody, welcome back to our series with Todd Langford, the founder of Truth Concepts, and we're doing a lot of fun conversations. In the last video that you will for sure see before this one, and if you haven't, make sure to go back and watch it. It'll either pop up here, it'll be in the link down below. We talked about ripples, and we talked about all the different ripple effects that happen, especially when we're looking at saving, investing for the future. And there's so many gems from that, of like investing with a purpose. Every decision you make has consequences. We looked at a bond and equity mix, and we pretty much made the assumption, or made the conclusion, is like, if you understand how whole life insurance works and operates, there would be no reason for you to have a bond, because it works. It's almost better in every category, period. And so we looked at literally average rates of return, actual rates of return, and we unpacked that whole thing. And so again, if you've not watched that, please go back, watch that video before you watch this one. But now we're going to talk about distribution planning, and this whole concept of like coming down the mountain. It's again, complicated topic, but we're in this series with the founder of Truth Concepts, Todd Langford, who's the right person to have complicated conversations like this. And so, how's that intro, Todd? The most longest intro for potentially the most boring video yet, but I think we'd be surprised on how many people are going to love this.
Well, you're right. It can be very complicated, and we try to simplify. But when we get into numbers, people just aren't tuned to looking at the number side all the time. But we really need that to make sure that what we're talking about is the truth. There's a lot of people that, in the financial industry say, well, I'm just a conceptual person. Yeah, but your math is wrong. So the concept is wrong, right?
We're definitely going to cut that out and use that as a meme. Like, you're just a conceptual person. Yeah, but you're, so I love that. That's my favorite line yet for the day right there.
So let's dig in, and yes, we're going to use some math, but I'm going to ask people to kind of step outside of what they're thinking for just a minute, and we'll come back to it and address it when I look at this scenario. And so what we're going to look at is the idea of what happens if we leverage two certainty events to end up with a better picture. And those two things that we're going to leverage are death. That's going to happen. That's a guarantee. And if we have life insurance that's permanent, that's whole life insurance, and it's guaranteed to pay out, and it has to be whole life insurance because really that's the only one that's guaranteed to pay out at death, right? And so if it's guaranteed to pay out at death, we can leverage the fact that we know money's going to dump into our estate at some point in time, guaranteed. And, we alluded to it in the last conversation, and that was, if you knew you were going to win the lottery at some point in time out in the future, would that change how you could spend money today? And it's that idea because we have two guarantees that we're going to leverage against each other. But what I want to look at is, let's say that we've got this 35, 40-year-old, whatever, currently, and we're going to put life insurance, whole life insurance in place as part of our investment strategy. And we're going to compare that to if we didn't do that and we just bought into the buy term and invest the difference type of strategy. And now we're looking out at age 70 and starting the distribution phase. And what do those two places put us in? Now, one of the things that you talk about often, Caleb, is the and asset idea with whole life insurance. And it's this idea that since we have access to the cash in a whole life policy, we can actually use that cash when great deals come along so that we can take advantage of them, right? Since we can get the money in a hurry, we don't have to wait for the bank to approve it. We can take advantage of some great deals that come along. And so in reality, somebody who didn't buy life insurance could accumulate X amount of dollars out to distribution age. Somebody who bought a combination of life insurance and other assets could also, as the cash value grew in that life insurance, could also buy other assets, and the income off of that could pay back the loan for the life insurance policy, so that literally they could arrive at age 70 with the same amount as the other person in assets, plus have the life insurance policy in addition to that. Mm-hmm. Now, a lot of people will say as well, because they look at life insurance as a cost, because most people look at all insurance as a cost. They think about it like their homeowner's insurance, their car insurance, even term insurance, right? Where you hope it's just a cost. You don't want to collect on those things because that means you had something catastrophic happen, right? Whole life insurance is a different animal, right? We could buy life insurance and use it along the way to grow assets even bigger, so that we have the assets and the life insurance instead of just the assets, as somebody who bought into the buy term invest the difference strategy. Does that make sense?
Yeah. So this will be the Caleb summary. So we're almost doing like a scenario A versus scenario B deal. And scenario A, you're talking about someone who's buying term, they're being responsible, and they are investing. And over, the whole story goes that when they hit the retirement, that their term will drop off and they'll have their assets and they'll be able to ride into the sunset kind of deal. And then the scenario B, that person is utilizing whole life insurance. And so they don't necessarily need to buy term insurance on the side, but this is structured in such a way where you can use that to also invest. We could assume the same rates of return that scenario A got. And at the end of the day, you are getting to a place where your assets probably are a little bit less, because if we're adding the drag of life insurance from a standpoint of it getting started and then potentially the cost of borrowing, but you have that assets, the investments, and all the benefits of the life insurance there. And so we'll see when it comes down to the, going into retirement, the distribution stage, what person's better off. I don't know if but that would be like my version of setting the stage.
Yeah. So out there in the future, like I say, we should be able to be at the same place in assets plus the life insurance, and we'll look at it if we're a little less or not. So let's look at this, and what we're going to do is we're going to take this out, and we're going to look at 20 years from age 70 to age 89, and we're going to look at, say, $2 million has been accumulated across this time frame. This was the buy term and invest the difference type of strategy. Now, let's think about this strategy for just a moment from the standpoint of the financial institutions. It's the financial institutions that brought on the idea of buy term and invest the difference. Now, it's been pushed out there more and more by some of the financial entertainers that are around. But really, it's all to the advantage of the financial institutions, because think about this. Who gets to really use the money during the accumulation phase while we're piling that money up?
They do.
Yeah. It's all in the hands of the financial institutions, right? Are they just sitting there paying you interest because You're depositing money with them. No, they're taking that and they're making more than what they're paying you. That's how that works, right? And so all along the way, the financial institutions are loving that type of strategy. But when we get to that distribution age, in this case, we're using age 70. When we get there, that's when we're actually supposed to finally reap the benefits of all that saving that we did. But here's the key piece. We set ourselves up, or the financial institutions programmed us to set ourselves up so that during the distribution phase, we still leave the bulk of the money in their hands. And this is what I mean. We accumulate, say, this $2 million. We get out there to the end. We don't know how long we're going to live. And the rule during that retirement phase or that distribution phase is you don't ever touch principal, because if you start touching principal, it could fold down fast and you don't know how long you need it to last. So now that you've gotten to the place that you're supposed to be able to use it, you're leaving the bulk of the money, the $2 million with the financial institution, and all you're doing is taking the piddly interest off to live on, right? So brilliant from the standpoint of the financial institutions, not to be a conspiracy theorist, but that's really the way that works.
It's well said. It's well said.
Okay. So let's say we get out there and we can earn 5%. Let's say that we have a pension and some Social Security of around $50,000, and that's not going to really influence the calculator. It's just going to adjust where we are in the tax brackets from a taxation standpoint. And so what we see is this $2 million, if we didn't touch it, would grow to $5.3 million. But the point is, this was created for us to live off of, right? And so going back to the strategy of buy term and invest the difference, what we're going to want to do during that distribution phase is consume interest only. Leave that principal alone to grow so that it makes sure that it lives as long as we do. And so when we go interest only, we can pull out $100,000 a year. We're going to have to pay $17,000 in tax based on current tax law, and allow us $82,000 to spend. And that's going to be kind of a shock to a lot of people because, $1 million in retirement has kind of become a number. Well, it hadn't become a number. That's been a number that's been around since like the early 1900s.
Yeah.
And
yeah, it's crazy.
Yeah. And yet here we are, we're still talking about $1 million. I guess the reason is it's too far to make a jump to $1 billion, certainly. So, what do you use, 10 million? I don't know.
Well, and the sad reality, like if we start drinking now, is $1 million's a lot for a lot of people. And I don't say that like jokingly. It's just like if you look at the data, people they don't have money. And that's the system. There's a lot of reasons for that. So it's sad that, like, on one hand, we're looking at $2 million and you're making the comment like, yeah, this doesn't have the same effect. And there's a lot of people looking at that number that says, Todd, you're being so unrealistic. $2 million, like that's crazy. So I think it's just a tough space that we're in right now. And it's only going to get worse as inflation happens and as people are saving less. So it'll be interesting to see what the future looks like.
And what's amazing is at the $2 million number, it's still only $82,000 a year of income, which is going to be, that's a shock that
inflation. That's the other thing is like, is that today's dollars or is that, future dollars? And that gets less and less valuable every year. And so that's another thing that inflation just is an eye opener for so many people.
Absolutely. So if we look at this, and we think about what's happening here, what would happen if we get out there and here we are at age 70 and interest rates aren't 5%, but really safely, and see, when we get into that distribution phase, we really can't afford to take on risk. Everything's got to be pretty stable. What if safe money is only 3%? What happens is our income goes down to $51,000. It directly impacts everything we're doing. And, we talked in the last segment about stress in our lives and what that does to health. There are a lot of people that sit in this place where they've got money, but because of what's going on in the market, those fluctuations in safe interest rates, they're pretty stressed out about how much money they're going to have in this interest-only scenario. If interest rates drop like this, it directly impacts how much they have to eat on, right?
Yeah.
So really tough. Let's go back to 5%. And as you mentioned, inflation, and I think this is a tough one that, is hard to get your head around, because inflation is like compounding interest. That's
Yeah.
the thing. It's not just an amount that happens one time.
Yep.
And if we look at even 3% inflation, look what happens here.
Yeah.
It's pretty much cut in half over 20 years as far as what it'll buy. It'll still be down here $80,000. The problem is everything's doubled in price by then.
Yeah, I love that feature, by the way. Love that feature of the calculator, because we see it a lot of times. People factor in inflation and they just inflate what you need to be consuming. But this is like actually taking the dollar amounts and putting it into quote unquote today's dollars. Um, so I think that really is eye opening.
Let's turn inflation off, and let's just, while, like you said earlier, accumulating $2 million is way above average, and yet we can still see the problems that exist around it, uh, because we followed the buy term invest the different strategy to get there, right?
And
But
and
let's
to be fair to this model so far, I don't know if I'm jumping ahead, but you're using 5%, and a lot of financial professionals out there and experts are saying that 3.5 or 3% or 4% are because of potential volatility and all. And so to be fair so far to this model, this is actually being generous to say 5% every single year. And so just wanted to point that out.
great point, and you're right. I think Wade Fowle's number to have 40 years of a 95% chance of success in the marketplace, withdrawals can only be what, like 3.2 or something like that.
Yeah,
It's
I've seen 2.9. I've seen 3.2. I've seen a lot of different numbers, and it all is pretty depressing at the end of the day. So it's like, all right, well, let's say 4. We'll say 4, but with the asterisk.
maybe we'll have some high yield savings that'll do 5% out there, right?
That's
Like they are,
right.
you know. All right, and so let's look at the other alternative, and the other alternative was buying permanent life insurance, whole life insurance along the way, as part of our portfolio, and using those dollars to also buy additional pieces of investments like real estate that could pay the loans back, all kinds of different things. And what if we ended up with $2 million plus the life insurance? And we'll look at that at full value first. We actually use the life insurance policy along the way to benefit us in our investment strategy. And so here we have $2 million of liquid assets earning the same 5%. And we decided, what we could do? We could leverage our guaranteed chance of dying at some
Yeah.
point and the guarantee that whole life insurance will pay a death benefit at the point that happens. And let's leverage those two things against each other and take on a different strategy. And that strategy would be, let's consume this account over 20 years. Let's not let the bank be in the driver's seat and hold the bulk of the asset while we use just the interest. Let's use principal and interest. After all, we put it there. Shouldn't we be allowed to spend it?
Yeah. And so,
And
Todd, I
so,
just want to clarify this because I think I misunderstood you originally. We're not right now including the cash value component of whole life.
no,
We're just looking at the permanent death benefit.
that's right. The permanent death benefit is on the side. We're not even touching that. We're just looking at 2 million in assets right here. Just like
Right.
the person on the left is 2 million of assets, with the knowing that death benefits out there to replace this if we die.
Awesome. Okay. Great.
Okay. And so if we spend this asset, this liquid $2 million, we could take out over 20 years $160,000 a year instead of just the 80 that we saw before. And there's an interesting thing that happens when we do that. So this strategy actually creates a reduction in our tax bill. If we look at distribution A for just a minute, what we're going to see is our tax bill is $17,570 every single year all the way down when we take out interest only, because we're paying taxes on the interest that's earned. In other words, on that $100,000, we're having to pay taxes every year, right? But when we shift to the pay down in distribution B, what happens is the first year it's the same because we earned $100,000 the first year. But as time goes on, less and less of the money we're pulling out is interest, and more of it is principal, which is not taxed. And so it causes our tax bill to drop over time. Now, what that does is it actually gives us an increasing net spendable. And so what's interesting is there's really only one way I know of to beat inflation, and that's just to have more money. Right?
We need that on a t-shirt, Todd. We need that on a t-shirt. How many people would buy that in the comments? If we get 10 people to do that, I'll make t-shirts.
And so here we're at least moving in that direction, right? If we have more, that's going to help stave off inflation. This probably isn't going to be enough to totally get rid of it, but a level income is going to be decreasing quite a bit because of the, as far as its buying power, because of the impact of inflation. Here, by having more and more net income, we're pulling the same amount out, but we're paying less in tax, is going to help, offset inflation a little bit. But when we do that, over time, we're going to spend a lot more money, $3 million instead of what we had on distribution A. Now, is it possible, since it's the same time frame out in the future, that interest rates might not be 5%? Could they be 3%, like we saw before with the person that did buy term and invested difference? Well, what happens when we go to 3%? When we do that, you can see that the income dropped, but not by very much, not nearly the ratio that we saw before. And you can say, well, wait a second, why is that? And the reason is because we're spending a lot of principal here, and that this principal didn't earn any interest anyway. So while the first scenario is very stressful from the standpoint of what is the market doing, because all of the income, all of the spendable dollars we have is totally related to whatever the interest rate is in that year. Here, only part of the money we're pulling out is exposed to the interest rate fluctuation. So really, this helps have some market protection, or whatever you want to call it, during that distribution phase, by having the ability to do this strategy. And the life insurance death benefit is what allows us to do that, because if we look out here, we're going to totally consume this account. What happens to our heirs? What happens to our legacy or other pieces? Well, again, we leveraged that death benefit against the guarantee of our death occurring, and so that gets paid back up. But what if we outlive age 89? Is that a possibility?
Yeah.
I'd say it's a strong likelihood, with where, 100 plus is the largest growing or the fastest growing group right now. I mean, that's kind of a skewed statistic. What is it? The old adage, there's lies, damn lies, and statistics, right?
I feel like that can't possibly be true, but I'm gonna just go with it, because you're saying it's faster than, or it's faster growing, because
yes,
if you go, you're saying more people are being born than entering 100, but that the rate of births are actually decreasing, or potentially staying level, where you're saying 20 years ago, 30 years ago is unheard of, and now the rate of people getting to 100 are a lot higher.
Yeah, well, it's the fastest growing age group, because when you go from 2 people to 4 people, you just doubled it.
Got it. Yeah, I got it.
But it is tending in that direction, right? And how much of our health is dictated by technology? I mean, technology is increasing longevity, and the thing about technology is it's not on a linear path. It is like a compounding account. It is exponential, because what we learn, it gets built on that, and so it's an exponential curve, and we can expect that out of the future. So what we're seeing in life expectancies now versus 40 years, that's going to be dramatically different. So there's a good chance that we could live longer than this. So we need to make sure we put $20 there in the pay down 2 year. Okay, so let's go to 5% here.
Okay.
And let's put 20 years on the pay down 2 year. And let's compare these two options together. So now what we see is there's actually a difference of $1.3 million in spendable dollars for this side, because this strategy was opened up to us by what? The death benefit, not the
Yep.
cash value.
Yep.
But at this point, it was the death benefit that unlocked our ability to be able to do this because it protected this asset and created that leverage, again, of its actuarial leverage, right?
Yep.
And so here we have a huge difference. Now, let's go back and look at that. Put 3% as our earnings on both of these and look what the difference is. A little bit less, a lot less.
Wow.
And now our difference is $1.5 million out here at the end as far as what's spendable. Go
Yep.
back to 5% on both of these. And actually, let's do this. Put 5% on the left and put 0 on the right. No interest earned on this. And we still spent $351,000 more with no interest.
Wow. Wow.
Because with no interest, we also don't pay taxes, right?
Yeah. So you're spending
And
down
so
2
we can
million.
literally
Yeah. Yeah.
spend more money than the person on the left.
Yeah, Todd, this is amazing. There's so many people that are overcomplicating this conversation, and they use the cash value as well. Because you could make the argument that a person that has whole life insurance has a different way of thinking, and that they could earn greater assets and all. And like we could make that argument, and that's philosophy, and some of it would be right, some of it would be wrong. But at the end of the day, we're literally comparing apples to apples, and because of a permanent death benefit, you're unlocking a lot of money, 1.5 million in some scenarios, but like that is insane. And we're comparing the exact same distribution strategy. In the last video that we did, we literally talked about how you could potentially get a greater distribution if you have whole life insurance as a part of your like we're not even talking about that.
Right.
We're not even talking about that. We're literally saying apples to apples. One person has a permanent death benefit, the other person doesn't. That's an unlock. I appreciate that you broke that down, because all the other scenarios we could do could compound this fact. But that's like a really good place to start. And then I think everyone's been doing this almost wrong, is they've complicated it. And then they're like, oh, by the way, you have a death benefit. Whereas like
Right.
if you set the stage of like, okay, everything's the same. One person has a permanent death benefit versus the other person, and then it's like you set the stage, and then everything else that you talk about can be compounded and potentially could be measured. Hey, it's Caleb Williams here. I'm just interrupting this video quickly to invite you to check out our And Asset Vault. You may have been there. We've actually revamping it, and if you are somebody that wants to learn more about, is life insurance the right fit for me? Does this And Asset make sense? Like, does this actually help me be more efficient? We've put together a 10-minute documentary style video that I think does a really, really good job giving the history, why the And Asset, different setups and designs that we use. And then we have an And Asset Vault that gives like case studies, calculators, handbooks, and so much more. We are here to serve you, whether it's a conversation, whether it's education, or the video. So make sure to go check out andasset.com/vault to learn more.
Yep. And let's look at that, because I know in a lot of people's mind, one of the things they're thinking about is, okay, but if we had the life insurance, what if we didn't do as well in the rest of our assets and we didn't get to the same $2 million? Well, let's just adjust that. So let's make it 5% over here, and let's change this. What if we only ended up with the life insurance and $1.3 million?
Which is,
we still spent $332,000 more, and this was more dependable. In other words, the market fluctuations aren't going to impact this one over here as much as they are the one on the left. So even with a massive reduction in the amount we end up with, because we have this strategy afforded us by the death benefit. So think about during the accumulation phase, that cash value was really helpful in helping us create other assets, that and aspect, right? And now we get to the distribution, and that death benefit that we thought was from somebody else is actually going to unlock stuff for us.
Yeah.
And
Todd,
so
I appreciate this a lot. Like, cause I just had a light bulb moment, because I've always mentioned like death benefit is important, but I think this is the first time that I've actually seen death benefit not commingling with cash value and all that other stuff. And I think this video should be a must watch for people that are nearing nearing retirement, in retirement, that have a permanent life insurance policy as a part of their portfolio.
We need to look out into the future. I mean, this is at zero. What happens if we live longer than this, like we just talked about? I mean,
Yep.
let's go back to the 2 million for just a minute over here, because that really is what we should be able to do.
Yeah.
And we extend this out to 40 years instead of just 20. And the problem is we ran out of money right here. While the person on the left, while the 82,000 didn't buy in very much, it's certainly more than nothing, right?
Mm-hmm.
But what's not included in here is that life insurance policy that's now grown all of this time out here. Even though we stopped paying premiums at age 70, it's still grown. And we need to add that to this illustration to see what it looks like. So let's pull that life insurance illustration in, age 70. So it's the 35-year-old policy, but now they're 70.
What type of premiums are we using?
This had a premium. It's all paid up at this point in time. It was around 21,000, I think.
Okay.
And this cash value, so the death benefit at that point is $3.4 million, and the cash was about $2 million outside of what we have here. And when we look down over this time frame, we would actually pass more. And this policy was run with distributions from the policy after we consumed that first account. So we consumed that main $2 million account out to age 89. Then we can lean on the life insurance cash value. It's better to hold that life insurance till the last asset. And if we had some other assets in here, we would spend them first before going to the life insurance cash value, just because it performs so well on the back end. And it's the protection to allow us this strategy. And so what happens is now when we scroll down, what we see is we can pull the $160,000 a year out all the way through, which actually builds the other account back some. We still have cash value and death benefit. So if we die, we pass 4.7 million rather than only 2 million.
Yep.
And if we lived this whole time, which we should expect to do, we spent $2.8 million more across this time frame.
Yep.
Which means we could also, and this may be going a little too far and getting a little bit too much info, but I think it's important to address that inflation issue. The one on the left has no inflation protection, and right now, this one on the right, we haven't adjusted for it. But what if we adjusted this where we could continue our 3% increase in the amount of money we're pulling out over this time frame? Would that be helpful so that we had an inflation-proof number over here?
Yes.
Maybe it starts out similar to the one on the left, but ends up with more. And so let's increase these distributions by 3%. So, and turn on the steady net withdrawal. And go ahead and turn on. So we see we have an increasing amount coming out on this side, but let's add inflation to this. And now what we see is we pull out $112,000 a year level, and look what happens to the person on the left.
What exactly did you do to?
So what we have here is we're pulling out, look at our withdrawal in that gross end of year withdrawal column. We start with 133,000. The next year we pull 136. So we're pulling 3% more out each year to offset what's happened with inflation, so that after inflation number is a level 112,000 every year.
Yep. No, I got it. I think I think a lot of people probably did what I did, and now I think we're on the same page. We're factoring in inflation, and I understand the logic now.
Yeah, and so what happens is, and this is life, and I don't know how many of you have seen older people reach retirement age, and generally what happens is the first few years of retirement, it's pretty much like it was before retirement. But all of a sudden, they start to feel the impacts of inflation, and they stop doing things, right? Yeah. A lot of people think maybe it's health reasons, but I think for a lot of people, it's money reasons. It's because inflation is doing what we see there, 80,000 down to 77, down to 75, down to 73. I mean, those are big hits each year as that drops to keep up. On the right-hand side, having that level income after an impact of inflation, that is a completely different life. And
Yep.
that's what we're looking to do, right? And what caused this? The life insurance death benefit. And that is
Yep.
what is so cool is we don't know what opportunities are going to be out there for us in the future. So we need to have options open to us so that we can take advantage of whatever's available. And this is
Yep.
just one of those potential strategies that we can do.
Todd, I appreciate you breaking this down, and I think we may want to do another video, and love to hear you in the comments if you think that this would be helpful, is to almost do a case study from at 35,
Yeah.
and like look at what they're, because a common question I have in my head, it's like, okay, I love the first scenario where we're doing 20-year versus 20-year. We're same assets. Now it's like we are whipping out an additional asset, which that person does have, and we let it mature. Like everything's relevant, but we also are assuming that this, in that scenario, that distribution B is a better investor than distribution A. So it would be, what I would love to, and maybe I'm wrong on this, but there's a pure cost. And it's like, I would want to assume that they're investing in the same exact things if we're going to compare apples to apples. And so what I would wonder is the only difference really would be is the investment, instead of having 2 million, would potentially be a little bit smaller, but we would still see it smoke. And you just showed it even at 1.3 million, which
Yeah.
is
Let's do that again.
drastically like that. So that would be like an interesting case study. It would be like we would like walk through like, okay, what are they doing in their 40s, 50s, and then how it plays out. But for someone like me, maybe I'm the only one, I would really like that, because there's a lot of people that watch the show that are in their 30s and 40s and 50s that are like, they get the benefits of the and asset in the accumulation stage, and then they get the benefits of the and asset in distribution. And it'd be like, I think, really special to be able to see that firsthand.
Yeah. Well, it is interesting because we have that ability because we have access to cash. And
Correct.
what people typically want to compare is parking money in the life insurance policy
Right.
against other options. Well, wait a second. I understand why, because most of the other assets are or assets. They don't have a choice but to park it in those other assets. But with
Right.
life insurance, we can have it doing what it's doing there and still have access to it to do other things as well when that opportunity comes along. And
That's
so
right.
that's what needs to be included in that other side. But even here, if we go back and we look at, what happens if this has, what we have before, 1.3 million in it?
Yep. And I understand in this scenario, there's a lot. It's just, these are
Yeah.
the kind of questions that I have. Yeah, it's still $1 million difference. That's incredible. That right there is just like, we got to continue to hammer different angles here, because we have a retirement crisis on our hands.
Oh, yeah.
And when I say nobody, I don't actually mean nobody. But when you actually factor in the conversations, all the gurus, all the X, Y, and Z, like very few people are having conversations about life insurance, and it's demonized as a bad investment. And it's a shame. It's
Yep.
a shame that people aren't understanding this, because we would be in a way better place if society would be in a better place. Like, this would be better for America if we got less emotional about just like our own selves. We'd all be better off if we all had life insurance. But newsflash, like, your retirement scenario would be better off with life insurance. The people that would be worse off, Todd, are Wall Street. That's the asset managers are not happy. But at the end of the day, it's like, I wonder what needs to happen to get this to more people. And I wonder if there needs to be a government action. I'm not a government type of person from a standpoint of they need, but I just wonder if, like, all these things that no one wants to talk about, Social Security and all these things, I wonder if there's a creative solution when it comes to life insurance that could potentially solve some problems.
Yeah, it's a good question. And I think the really tough part here is there's some responsibility here for the investor, for the person that's growing money for this. And that is, they have to push the bias aside. They have to stop listening to the noise on the media, because the thing about it is, with the web, you can find information to support whatever argument you
Correct.
want.
Yep.
And it's the bottom line, right? And so it takes more than that. It takes the math. It takes, having your financial advisor show you this in a way that's understandable. And I think one of the other things that happens in the financial world is it's this idea of let's complicate it so much the consumer can't understand it, and they'll just sign it and say, okay, whatever. And then they don't find out they have a problem until 30, 40 years later when it's difficult to fix, right?
Yep.
And so if it can't be explained at some level where it's logical, yeah, I don't know. It's
Yep.
probably flawed somewhere, right?
Yeah, I congratulations to the people that have watched this entire video. We definitely want to hear your thoughts. Would a full case study, like full case study of Susie A versus Susie B, be helpful? And what other questions that you have? Because again, we're in a series. Todd, you've been so generous with your time. If you are in our profession, if you help people for a living, help them with stuff like this, like sign up for Truth Concepts. There's a lot of exciting things coming down the pipe. Todd, you're always innovating, and it's just fun to see that. And then if you are someone who's like, hey, I want to learn more about this, we also have links for people like you. If you want to learn more about what we call the and asset and life insurance, we have education for you and a lot of good resources. And it's just an honor to do this with you, Todd. Is there anything else that you want to say? There may be more to this story. I think that this was a phenomenal video. I was skeptical at first. I think we both were a little bit, but I think my hope is that someone will rewatch this if it was a little fuzzy, because I think there's nuggets that we were able to show in numbers that were pretty remarkable.
Sure. Well, this is a little bit of a complicated example. The numbers play it out. Watch it again. Just don't get overwhelmed. Think through it and what the possibilities are, because it is I pat you on the back too for hanging in there if you've made it this far, because there's a lot here, and I don't know that there's an easier way to get that across, a less complicated way, but hopefully it makes sense.
What I really appreciate is that we started with the death benefit, and that for me was because I can all day long, because if scenario A, you're buying term insurance, there's money that's quite frankly going out the door. Praise God, you didn't die in the 30 years, but it went out the door. And so it's like I could knowing how life insurance works is, in the first couple of years you have maybe less money, but over time there's a break even, and the asset's actually becoming more and more efficient. And so I can totally get to you have the same dollar amounts. I think that's generous, quite frankly, on scenario A. If I'm being honest, that's a generous scenario. And just looking at the death benefit, not factoring in the cash value, I think that's powerful step one. And then when we add in the life insurance, that's where it's like it gets a little bit more complicated, rightfully so, but at least it's like stepping stone. And I think you were the first person that did it that way versus almost everybody else is doing it. They're using the death benefit as like the final point. And I've done this for my entire career, and I'm going to start shifting that. And I think you've given us a framework to be able to do that. And so for that was like the big nugget for me. And we've always say that the death benefit is this permanent asset that you should utilize. But up until now, I haven't seen someone illustrate it the way that you've illustrated it.
Right. Well, there's plenty of different ways that creates that side of it, but it is an interesting thing about how powerful that death benefit is during the distribution phase for people. And it's hard to see that, at 35, 40, 45, 50, whatever that is before we get there. But that death benefit really comes along and makes other assets better. And one of the things that happens, and I've got a good friend, and he says it this way: smaller assets behave like larger assets in the presence of permanent whole life insurance. And that's really what we showed. Even when we cut this back to $1.3 million, the life insurance unlocked a strategy that allowed it to actually still outperform an asset that had $700,000 more in it, right?
Yep. Love it.